Welcome back to the channel, where we equip you with elite financial strategies. Today, we are tackling into two fundamental pillars of wealth building that are often misunderstood, especially for high-income professionals: credit scores and effective budgeting. If you are earning a substantial income but still feel like you are not building wealth as fast as you should, this video is for you. We are going beyond the basics to give you an actionable insight tailored for your complex financial life. Stick around because by the end of this, you will have a clear roadmap to financial mastery. Let's start with stark reality. High incomes don't automatically guarantee high net worth. It's a paradox many high earners face. Studies show that households bringing in $200,000 to $250,000 annually often have an average net worth of just around $630,000. This isn't because they are irresponsible. It's often due to the lack of a strategic allocation and falling prey to lifestyle inflation. The difference between feeling perpetually broke and building real freedom lies in mastering these two areas. Those are credit and budgeting. Today, we are going to break down exactly how. First, the credit scores. Think of your credit score as your financial passport. It's a numerical expression of your credit worthiness, and it dictates the terms of nearly every major financial transaction you will make. We are talking mortgage rates, car loans, insurance premium, and some job opportunities. A higher score signals lower risks to lenders, which translates into massive long-term savings on interest and access to better financial products. It's not just about getting approved, it's about getting the best terms. In the US, you will primarily encounter two major scoring fund models: the FICO and VantageScore. While both aim to assess your credit risk, they have different methodologies. The FICO, for instance, is used by 90% of top lenders and heavily weights your payment history. VantageScore, on the other hand, is gaining traction and places a strong emphasis on your overall credit usage and available credit. The key insight here is that you likely have multiple scores, and understanding the nuances of each helps you to optimize both of them. Now, for the global audience, it's important to note that credit scoring varies significantly across high-value markets. While the US and Canada typically use a 300 to 850 scale, the UK's Experian score can go up to 999 and Australia's Equifax score ranges up to 1200. The strategy here is to localize your understanding. Know the specific scoring models and the ranges in your regions where you are building your wealth, as this will directly impact your financial opportunities. So, what actually makes up your credit score? There are 5 key pillars you need to focus on. First, the payment history, accounting for 35%. This is the most crucial and critical factor. never miss a payment. Second, amounts owed or credit utilization makes up around 30%, keeps your utilization below 30%, ideally under 10%. Third, length of the credit history at 15%. Older amounts are gold, so don't close them. Fourth, the credit mix. That's 10%. A healthy variety of loans and cards is beneficial. And finally, the fifth one, the new credit, also 10%. Limit hard inquiries to ever temporary dips. Master this 5 and you are well on your new way to an excellent score. Now, want to boost your score fast? Okay, here are the some of the strategies, moves, the utilization hack in the first one. That's actually pay down your credit card balances before the statement closing date. This report a lower utilization to the bureaus considering the authorized user status. As the second one, if someone with excellent credit adds you to their account, their positive history can benefit your score. And always, at the third number, always audit your report. Dispute any errors immediately. Even small inaccuracies can drag your score down. And for those rebuilding, the fourth one, as the secured credit card, is a reliable path to demonstrate responsible credit behavior. Now, let's talk budgeting. For high-income professionals, traditional budgeting advice often falls short. It typically ignores the complexities of RSUs, bonuses, and integrate tax brackets. The biggest problem, lifestyle inflation, where every raise gets absorbed by increased spending. We need to shift our mindset from can I afford this to does this build my net worth? This fundamental shift is crucial for true wealth accumulation. Now, forget the standard 50-30-20 rule. For high earners, we need to make a modified framework for accelerated wealth building. We are looking at 45 to 50% for fixed necessities, your housing utilizes and essential living. Then 15 to 20% for the discretionary spending. Enjoy your life today with a focus on values-based spending. And critically, at least the 30 to 35% for your wealth building. This is where aggressive savings, investments, and tax planning come into play. High earners should aim around for 25% or even higher savings rate to truly build significant net worth. Now, speaking about the bonuses and RSUs can be a game changer, but also they can also fuel lifestyle creep if not managed strategically. Implement the base salary rule that explains the budget all your living expenses on your base salary only. Create RSUs as with caution. Set aside 40% immediately for taxes, then invest the rest. View bonus logic as wealth acceleration, money directing it towards investments or debt reduction, and practice the systematic selling to avoid concentration risks in your company stock. Don't let these windfalls become just another expense. Taxes are often your largest expense. Minimizing is paramount. Maximize your pre-tax accounts like 401k and HSA to lower your taxable income. Coordinate charitable giving through strategies like bunching for high deductions and actively manage your W-4 withholdings to avoid massive tax bills or penalties. Every dollar saved in taxes is a dollar earned for your future. This is not about avoiding taxes, it's about smart, legal, and optimization. Now, the secret to consistent financial success, you know, it's automation. Remove willpower from the equation. Set up paycheck splitting to direct funds to separate expense and investment accounts. The autopay everything to eliminate late fees and design the decision fatigue. Implement the 50% rule automatically saves 50% of your future raise and conduct quarterly audits to review subscriptions and combat the budget creep for every 90 days. Automation makes your financial plan effortless. Lastly, for high earners, a standard 3 to 6 month emergency fund isn't enough. You need around a 12-month financial net, the safety net. High paying roles are harder to replace and take longer to find. Your fixed costs are often higher and less flexible. Target 12 months of necessity expenses, not total spending. This substantial cash reserve provides invaluable peace of mind and the leverage to take career risks or weather economic storms without financial stress. Now, coming to the conclusion, you have the blueprint for your financial mastery. Here's your 3-week action plan. The week 1, audit your credit report, dispute errors, and set up payment automation. The week 2, calculate your true take home pay and set your modified 50-30-20 allocation targets. The week 3, automate your savings and implement the bestseller rule. The result for that, a life of abundance now and guaranteed financial freedom later. If you found this guide valuable, please like this video, subscribe for more elite financial strategies and hit the notification bell so you don't miss our next deep dive. Thank you for your watching and we will see you in the next one.